Well, let's talk about the Real Income Fund, launched in 2009, in January 2009. Your benchmark here is about achieving CPI plus 3%. And obviously, you've got a very big focus on the fixed income front, large exposure to inflation-linked bonds. But what I want to concentrate on this evening are those stocks in your portfolio. You're allowed up to 25% equity exposure. I think you're currently sitting with 15% equity exposure. And the stocks that you have chosen are those which you feel can effectively beat inflation. So let's start with the food stocks in your portfolio, Arno.
Sure. I mean, on the food side of things, what we're looking at, we've only really got 4 stocks. It's Astral, Oceana, Zeta, and then sort of not quite a food stock, but more indirect in a sense, is Omnia. I think what we're really trying to get to here is we need to make it clear that this is not about a stock picking type approach in the sense of that we're trying to outperform the market or anything like that. The stocks, not just the food stocks, but all of them, and there's only 8 as it is, so very focused. What we're trying to do is pick up on very high correlations to inflation drivers. So what we do in the case of these 4 stocks is choose those stocks that are highly correlated to food inflation, well, as far as we can, and that are at relatively good valuations. So if one runs through it, you know, as far as the Astral side of things is concerned, let's sum it up in one word: chickens. And as far as the Oceana side of things is concerned, is the fishing industry side of things. And Zeta, of course, is a little bit more sort of widespread, as you almost look at it as a sort of a agricultural investment trust. And then Omnia as a bit of a fertilizer type play, as well as the water side of things as well.
I mean, Arno, it's Wayne here. Are you looking specifically at dividends here, or is it just the gearing to potentially higher inflation? In other words, what happens if inflation trucks along at 4 or 5%? Will you still get enough dividends from these shares to give you that inflation plus 3 return, do you think?
Not necessarily, Wayne. I think, as Bronwyn sort of pointed out at the beginning, is that it's an inflation-themed income fund. So when inflation's down, sitting at 3% odd, what we try to then do is to say, well, where do we get our best inflation pickup, or hedge, if you want to put it like that? And the first place, or first point of call, is going to be in inflation linkers. But as in any other asset class, there's going to come a time when inflation-linked bonds themselves are expensive. And then you say, well, what's the next best real yield that I can head out to for income-seeking investors? So it's not per se about the dividend yield as such. What we're actually looking for on the first level of analysis is, in fact, pure price movements rather than the dividend yield. The dividend yield is almost a sort of a second overlay, in a sense, as far as analysis goes.
And then, Arno, looking at your fuel stocks, uranium one, that's
yes.
He's choosing his words. He's choosing his words carefully.
It's not a widely held share.
Yes. Again, this is the point, is that what we're looking at is to say, as far as the energy cost side of things is concerned, so energy-themed inflation, and one of those in a broader context is in the uranium space. So we're looking at the generation of electricity, so it's about power. Now, one could arguably say that, you know, the average man in the street doesn't really have too much of an exposure to want to have to hedge against uranium. But nonetheless, what we're trying to do is to pick up within the fund stocks which are meaningful for an income investor who's looking to protect themselves against inflation drivers. And if the uranium price goes through the roof, unfortunately it went the opposite direction after March with Japan, the Japan incident, is we picked up uranium one from that particular point onwards to say, here's a great energy play, it's probably a very cheap asset at this point in time. Nuclear power stations are not going to disappear in the near term, even though we've only got one here, but in a global context, we thought it made a lot of sense. And it's paid off for us in that respect. But the first point of call is the correlation analysis that we try to do.
Let's touch on SASL. I have yet to meet a fund manager in South Africa that does not hold SASL. Are you buying more of it at 352 Rand?
Well, I suppose I'd have to put a disclaimer in to say that I do own SASL in my personal capacity as well. So, but look, the analysis in terms of where we're starting from is we're not going out there to go and kick the tires, speak to SASL's management, listen to their story, what their own forecasts are internally for oil prices, etc. What we're trying to pick up on is a much broader macro thematic story is, are oil prices going to be contributing to an upward surge in inflation, yes or no? If it's the case, then we say, what are the best hedges against that, or highly correlated stocks? And SASL runs continuously at a correlation of around about 80 to 90% against the rand price of oil. So if the oil price is going to be a contributor to higher inflation, then we are going to want to have SASL in the portfolio. Having said that, is the backstop for us is our exposure to the overall inflation basket via inflation linkers.
And
but
Arno,
so it's something over and above that for income investors.
How much of your fund have you got in inflation linkers? And then secondly, what's your view on that real yield now that you can get, I mean, almost cash in the bank on inflation linkers?
Sure. Real yield on R197, for example, which is the government linker, the most popular one, is currently sitting at around about, well, just below 2.6%, which on a, so let's call it a bigger picture view, a real yield of 2.5% odd is not such a bad deal. Having said that, it is those real yields are now sitting at pretty much historical lows as far as the South African market is concerned. So one of the questions we ask at Atlantic has been as far as valuations are concerned and market positioning. And what we are getting to the stage is that we think at around about 2.5% on a tactical basis it's probably not a bad bet to start taking some profits. So we have started cutting back on our exposure to inflation linkers directly. And started to look for better real yields elsewhere. So for example, looking at government bonds themselves, plain vanilla government bonds. 10-year government bonds sitting at 8.5% on a current real yield, that's 3.5% already. So,
Arno, very quickly, we are running out of time, but I have to ask you about your new gold exposure. It's a big debate point on this news desk in particular.
Yes, well, we don't like gold stocks per se. Having said that, what we see in the gold price side of things and in presentations around the country, one of the things we've been doing recently is saying, or asking the question, is gold a good inflation hedge? And the answer is no, it's not an effective inflation hedge. It's a very good crisis hedge. And you only have to open up any newspaper. In fact, you don't even have to open up the newspaper. It's normally on the front page. What's happening in Europe is crisis, and it remains here with us. It's not gone away, despite what the Eurozone would want us to believe. The US story as well. Japan is still coming at some way down the line. So we still think, I do believe that gold is going to be in a bubble, but I'm not going to predict when that bubble is going to burst.